Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, April the 9th. I want to take just a brief minute to discuss what equity markets did last week, as it was quite a recovery week in the markets, with the S&P 500 leading the way up 3.36% on the week. A very nice recovery to the upside for the week for the index. And the mid caps, as measured by the S&P 400, were up 2.94% on the week. Again, a very good week there as well. And the small caps, as measured by the S&P 600, were up 2.9%. So a great week all the way around as we continue to march higher from the bottoms that we saw last week. Now, no one really knows if the bottom's actually in yet. We will never know until we've had a couple of months to see if we truly have hit the bottom. But since we talked last Thursday, geopolitical headlines continue to be what dominated the stock market. And then as we got over the weekend, we learned that there was an 8 p.m. Tuesday deadline by President Trump for Iran to come to an agreement, open up the strait, and there would be a pause on the attacks. And that is what happened on Tuesday night. But very interesting, the market was starting to see through this prior to the announcement on Tuesday at 6 o'clock. So believe it or not, on Tuesday, the NASDAQ saw a volume of over 11 billion shares traded for the day. Now, this is very abnormal. You're typically on a daily volume between 5 to 7 billion on a day on the NASDAQ. And this is a very extreme day. The last time we saw volumes this high was April 9th, the bottom of the inflection point on liberation and the tariffs from last year. And so you saw volumes of over $11 billion in the NASDAQ on Tuesday. Over 7 billion of the volume was for buys, not for sells. Again, ahead of any announcement, ahead of any agreement. What the market was positioning and telling us, and again, is saying that we understand that even if there's not a deal there today, this is not going to drag. We do not, as the market, believe it's going to drag on. You saw a drastic reversal in oil prices and energy prices on Wednesday once the agreement was announced, with energy down 17% on the day at the lows of the day. And so what really investors started to piece together, while this conflict is not ideal by any stretch of the imagination, gas prices moving higher really hurt, and it's not fun for everyone. But then investors started to realize, well, the energy sector is 4% of the S&P 500. Gas comprises anywhere between 2 to 10% of income for the average American. So while it is more expensive, it is not crippling. It's not fun. You have to cut back elsewhere. But the other side of that is that the companies that are within the S&P 500 are not, we don't have we're not a manufacturing-based economy where the input costs for these companies are not tied to the price of oil. We are not like a company that's more sensitive to that. We are a net exporter of oil as a country. So all that being said, the market started looking past, at some point this will resolve, and things and valuations are very affordable and cheap at this point, and we're going to go ahead and make a bet and start buying up some shares. And that's what happened this week. Yesterday was a very sharp market rally on the news that broke Tuesday around 6 that a deal had been reached. Now we're going to continue to monitor those headlines and don't know if we have peace for 2 weeks or not. We are very hopeful that is what happens. The other fear that was dominating headlines is that in the month of March and may have spooked some investors as well, is that the Fed may potentially raise rates this year. While the price of oil going higher may have a short-term inflationary impact, we still do not believe that the Fed is in a position or will be raising interest rates this year. So we feel like that might have been a little fear overblown. And so what you saw is a sell-off in accordance to that and a very high run-up in the 10-year Treasury. While we believe that inflation will remain sticky, rates will not, we don't believe the Fed will be moving rates higher. So how does that impact you, and what do you do as an investor? Well, the important lesson that I took away from all of this is the importance of staying invested through volatility and taking advantage of opportunities that present themselves when things get cheaper. Now, and understanding the risk involved with that things can, of course, always go lower, but the saying rang true to me last week, and for my own personal discipline was, it's not timing the market, it's time in the market, and being consistent and disciplined with your approach. So if you have questions about how to navigate the market volatility from these headlines, or where you think markets are going, especially now that you saw growth underperform value at the largest margin since 2001. What's very interesting about that is value has only outperformed for consecutive quarters one other time since 2001. That was in 2022. So it'll be interesting to see if value for Q2 of 2026 can continue that momentum higher over growth. So we're going to continue to monitor that and see if that holds true as we are getting ready to enter earnings season and hearing from the bank starting next week. So if you have questions, just give us a call. We'd love the opportunity to speak to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.